Thank you for joining us to learn more about a few key income tax and financial reporting items affecting us in the oil and gas space today. As a reminder, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. This information is not intended to create, and the receipt does not constitute a legal relationship, including but not limited to an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. I'm Joe Blice, Energy Industry Group Leader for Moss Adams. I have with me today Pat Hanley, our Energy Industry Group Tax Leader. Pat, why don't you start us off by talking about some of the tax implications?
Thanks, Joe. Today I'll be covering some tax legislation that came out of the CARES Act, a lot of which does apply to our oil and gas taxpayers. As you've seen by now, the April 15th tax deadline was deferred to July 15th. More recently, the other deadlines, most other deadlines before July 15th have been deferred as well. This includes second quarter estimated payment deadline of June 15th, also being moved to July 15th. With this, all late payment interest and penalties will not start accruing until July 15th. I do want to point out that in this environment that we're in, cash is king, and a lot of our clients have overpaid sales tax and severance tax in the past. We do have a sophisticated state and local tax team within our oil and gas group that can take a look at your prior filings, calculations, and what you've paid. And if there are overpayments, we could certainly help you amend returns and get that money back. One of the benefits coming out of the CARES Act is the Employee Retention Credit. If you've applied for or in the process of receiving an SBA loan, you're not eligible for this credit. The credit is equal to 50% of wages paid to an employee for each quarter up to $10,000 of wages, and it's maxed out at $5,000, and it is a credit against the FICA taxes due, and any excess is refundable. You can be eligible for this credit in one of two ways. One is if you've had a significant decline in gross receipts, beginning in a quarter in which you compare the same quarter from the prior year. 50% is the threshold, and so far in talking to our clients, we have not seen this apply. However, the other criteria may apply, which if you've gone through a partial or full suspension of operations due to the government mandate, the shelter in place or stay at home, you may qualify. In talking to our clients so far, it's been pretty much business as usual in the field. Our field ops folks are out in the field. So there hasn't been much of a disruption there. However, if any of your office employees have been hindered through this, either working less, for example, if an employee is only able to work 30 hours in this new environment where they were historically working 40 hours plus in the office, you may qualify for this credit. We do have a team of people that is well-versed in this area. It can help you look at your facts, determine if this credit applies, and if it does, help you through the calculations and filings. Through the Tax Cuts and Jobs Act that was passed in late 2017, NOLs were prohibited from being carried back and can only be carried forward subject to an 80% taxable income limitation. With the CARES Act, this rule has been suspended for NOLs generated in 2018, 19, and 2020. With no 80% taxable income limitation on the carry forward. The good news is you can carry back this NOL up to 5 years. And a couple things to consider. With the carryback potential to get previous taxes refunded, you're also looking at a benefit of rate arbitrage. Currently, NOLs are taxed at 21% if you're a C Corp, And if you can carry back before 2018, which cases taxes were assessed at 35%, you can take advantage of the rate arbitrage. Also, with the Tax Cuts and Jobs Act, there's an excess business loss limitation under Section 461L that applies to individual taxpayers, which basically says that any taxable loss from a trade or business that exceeds $500,000 or $500,000 if you're married filing joint, or $250,000 if you're single in any given year, any excess of those thresholds converts to an NOL subject to a carry forward, which is limited to the 80%. The CARES Act suspended this limitation for years 2018, 19, and 2020. So the good news is if you couple this suspension of limitation with the opportunity to carry back an NOL 5 years, there could be some cashback refund opportunities. Some of our higher income individual taxpayers in the oil and gas space saw this limitation apply in 2018 with heavy deduction of IDCs or with the 100% bonus depreciation write-off. Some of our taxpayers exceeded the $500,000 threshold, which we can now go in 2018 or 2019 and deduct more and possibly carry back these losses to a prior year and get refunds. Also, with the Tax Cuts and Jobs Act, 163J was imposed, which limits the annual deduction of interest expense. In this industry, there's a lot of leverage, and so a lot of our taxpayers were limited in the interest expense deduction. With the CARES Act, they increased this threshold from 30% to 50% of adjusted taxable income. With partnerships, this is only applicable for 2020. All other taxpayers, it's 2018, 19, and 20. However, if you were limited in 18 and 19, any excess interest expense carries forward into 2020 and can hopefully free up some of that interest expense and can be deducted. If you're a C corporation and you've paid AMT in a prior year and still have an AMT credit carry forward on your books, the CARES Act allows you to apply for a refund. You can either do that through the 2019 filing, or you can elect to use 2018 and file a tentative refund claim and get that cash back. If you're associated with a partnership, you're probably familiar with the centralized audit regime, also known as CAR. And through CAR, it's really, really difficult to amend or correct any prior partnership filing. There's some relief that just recently came out that reverts back to the old rules that allows you to amend Form 1065 and the K-1s in a much simpler fashion. And you can now amend partnership returns under this regime for 2018 and 19. However, you need to make these filings on or before September 20th of this year. I will now turn it over to Joe Blice. Thank you.
Thank you, Pat. I'll cover a few of the key financial reporting implications that preparers are facing these days, getting together the annual and quarterly financial reporting that may still be in process right now. And specifically, we'll talk a little bit about going concern evaluation, impairment of long-lived assets, and valuation of the accounts receivable and the need for an allowance potentially. Specific to going concern, as you all know, management is required to consider whether the company is going to be able to meet its financial obligations for a period that starts from a year from the date the financial statements are available for issuance. So if you're a month or two out from your balance sheet date, you've got a year plus a couple of months to consider. And things to think about, and by the way, none of these are prescriptive. This is all going to require some key considerations of facts and circumstances that are specific to your own situation. But thinking about cash flow modeling, what price do we use? And the commodity prices are all over the board these days. A single price may not be appropriate. The forward strip may be a good place to start, or a combination of pricing models suggested by banks and lenders, but key factors considered in determining management's price case should be documented and included in the consideration of going concern. Also think about what are your development plans and how can those be controlled or postponed to preserve cash. And if you decide that you might postpone some development plans, what impact does that have on cash flow coming in that you're counting on to support the ability to meet your financial obligations as time goes on? Borrowings under credit facilities may be available today, but we've also got to think about how likely it's going to be that the company will be in compliance with any covenants included in those borrowing arrangements as to whether or not the borrowing base may really be available when you need it to be. And then finally, if you've got commodity derivatives in place, don't forget to consider any cash inflows that may be coming from those to help you through the time you're considering. Same concept for impairment. It's dependent on that commodity price, isn't it? But some things to consider for full cost companies, the price is prescripted, so you don't have a whole lot of judgment there to apply, but there is a significant amount of judgment in determining whether your proved undeveloped reserves are still meeting the definition of proved reserves, meaning you have to be substantially committed to developing those properties within 5 years of the date on which they were initially booked as a PUD. Successful efforts. Q1 has an impairment trigger occurred. I'd say it's pretty likely considering what the commodity price environment has done. So there probably will be a robust impairment consideration required as you're putting your Q1 reports together. Same thing as full cost. We've got to determine how committed we are to developing the PUDs, and if those PUDs need to slip into probable or possible, what risk factors do we apply to make sure that the cash flows from those reserves are credible? We talked about the strip a little bit. Strips may be pretty reliable for the first 2 or 3 years, but after that, the trading on the strip becomes a lot less liquid. So management and preparers of financial statements will need to apply careful consideration as to what price to use after that. And then the $1 million question, if we fail step 1 of the impairment test, meaning we've got to move on to estimating the fair value of the properties, how are we going to do that? And I think that's going to be really critical and very difficult as time goes on, and it's going to require a lot of heavy concentration and consultation with your friendly advisors. On to AR. Just like an operating company is dealing with a deflated commodity price, those other joint interest partners are dealing with the same thing. So if you're an operator of oil and gas properties with a significant amount of receivables from your joint interest partners, we've got to be really careful to think about whether we're going to be able to collect all that AR. So things to watch for: if we're seeing a significant slowdown in the timing of collecting that JIB AR, maybe an allowance might be indicated. Of course, the operator will have some ability to net future revenues against the AR, but we've got to give careful consideration as to whether those revenues will be sufficient to be able to collect that AR and fund the ongoing operations of those properties. Some other things to think about. December 31, the downturn in the market and the COVID outbreak was largely accepted as a type 2 subsequent event, but at March 31, it is an existing condition, so we'll caution you to make sure and consider that we can't ignore the downturn in price. Any assumptions about price coming back is going to have to be carefully documented and considered. Another thing to think about, borrowing base redeterminations will be coming around in April through June. And what happens if the borrowing base becomes less than the amount outstanding under the line of credit? Well, if you know that before the March 31 financial statements go out, you'll need to carefully consider whether or not we need to reclassify some of that outstanding amount under the line of credit into a current liability. Unfortunate circumstance here, but the differentials against commodity price may flip revenue to a negative amount. In other words, producers may be paying purchasers to take away natural gas or crude oil produced to the extent the market can't bear that supply. And there's a consideration being discussed about, is that really revenue, and should it be shown as negative in revenue, or does, once the revenue goes negative, should that be reflected as a production cost? And we think largely that it is to be reflected as a negative revenue amount, but here again, facts and circumstances can override that. Careful consideration should be applied in determining how companies present that in their financial statements. In conclusion, we really appreciate your attention today. Hope you and all your families are safe and staying healthy, and wish you the best of success as you navigate the changes. If you need us, we're here for you. Please feel free to direct your questions to any of your friends at Moss Adams, or here's contact information for Pat and myself if you need to reach out to us. Thank you.